Yield of the benchmark 10-year government security or GSEC fell to its lowest in last 3 years on Wednesday on expectations that RBI will announce temporary liquidity enhancement measures. Today, that is on December 5th, it was at 6.796, up 1.65% from previous close. Bond yields have been declining since Friday after data showed that India's economic growth slowed more than expected in September quarter. India's GDP output fell to a 7-quarter low of 5.4% last quarter. Along with bond yields, overnight index swap rates were also down by around 20 basis points on Wednesday. Now, swap rates are the closest indicators of rate expectations. What this signals is that the central bank may loosen the monetary policy tomorrow via a lower cash reserve ratio for banks, which is currently at 4.5%. Now, what is cash reserve ratio or CRR? It is a monetary policy tool that requires commercial banks to keep a certain percentage of deposits as cash reserve in the central bank. Simply put, the amount that commercial banks have to keep as deposits to RBI or central bank. Now, it helps in maintaining a certain level of liquidity in the economy, helps in controlling inflation, ensures financial stability, and manages liquidity in the banking sector too. Now, when CRR is reduced, the banks have more money to lend because the deposits to RBI is lesser, and this increases the liquidity in the economy. As for market participants, the cut of CRR by 50 basis points is estimated to release over 1.1 trillion rupees into the Indian banking system. This will result in further decline of shorter duration bond yields as per experts. Now, is lower bond yield a good sign or a bad sign? To understand this, let's first understand what bond yields are. Bonds are fixed income instruments and represent a loan made by an investor to the borrower. So when you purchase a bond, you are lending money to the bond issuers, which is the government if they are government bonds and companies if they are corporate bonds. Just like companies share their equities via shares, they share debt through bonds. So in short, bonds are units of debt issued by companies and are traded like stocks. Now, these can be government bonds too. Now, what are bond yields then? Just like when you take a loan from a bank and you have to pay an interest to them, these bond issuers who are borrowers here will give you an interest. Now, this interest is the bond yield. This is the indicator of how much money you will earn from a bond or other debt instruments. So, higher the bond yield, higher the return on investment. Hence, yield is an effective rate of return that you will get when the bond matures or after selling it. And the bond also pays you an annual return. Now, this is known as coupon payment, which is the fixed return until maturity. Now, these bond yields and bond prices are inversely related. When bond yields are declining, the prices of the existing bond goes up. Now, how do bond yields affect the stock market? If bond yields decline, then the opportunity cost of investing in the markets also goes down, which means that the stock market becomes more attractive to investors. If the bond yields are going up, then it is also meaning that the debt market is more attractive. So if the Indian debt market is not attractive right now because it is giving low returns, the FIIs will also find the Indian stock market more attractive and the flows will be bent towards equities. So now if you look at the charts too, since Friday the bond yields have been going down, and since Friday too the markets have seen an uptick with Nifty going up by 2.33%. Now, good or bad? Well, you need to decide, because now equities are looking better than debt. So if you are invested in stock markets, your portfolio is all green, and if you want to invest in debt right now, the prices of bonds may be a little more expensive for you. For more such news and views, keep watching ET Now.
If you like this video, then like, share and subscribe to ET Now.